the way we go about our lending is a major factor. The standard of a multifamily deal is between 3 to 10 years, some 15 years, but typically it's between 3 to 10 years. And the reason why that is that these properties are expensive. You must exit because there is no way you'll be able to pay them in 30 years. Happy New Year to everyone once again, and I'm happy to see that we all crossed over. We are all in a new year. Today's event, I wanted to talk about something different, plan, visions, and all that. I was like, by now, if any one of you do not have a plan, then I don't know. You're on your own. So better still is better we reflect on what has been going on and so that we can do better in this coming year. So that's why we'll be discussing a different topic today, which is setting the stage, the market we actually in versus the one that people are hoping for. We all hope for something good, but it's unfortunate that as investors, we constantly need to navigate the constant challenges because the standard of a multifamily deal is between 3 to 10 years, some 15 years, but typically it's between 3 to 10 years. And the reason why that is that these properties are expensive. The thing about multifamily is that it's structured in such a way that you must exit because these properties are very expensive and there's no way you'll be able to pay them in 30 years. There's no way, especially the ones that are in multi-million dollars deals. So the idea for lenders is that the first period they are collecting their interest and later on you start paying the principal on that. So that is how it is structured. Knowing that, that means we don't have a lot of wiggle room like single family to make errors. So for those of you that are into single family, multifamily and single family, they are like this. They're entirely two different kind of management from beginning to the end. From the way you acquire it to the way you manage it, they are not the same. So you can't use that strategy for multifamily. They do not work. My point is that it's important that we know what worked, given that we have limited time between 3 to 10 years to exit. And so many deals have failed recently. I know some of you have invested as LPs, and I would like to ask, how is that going? Are you happy with your LP deals that you invested in? Have you invested as an LP before? So many people that exited between 2020 to 2023, they were very fortunate. So we know that many people bought properties in 2020 and they bought it wrongly and all that. So we'll be discussing what has been happening even up until last year and how we can navigate. We've had more challenges compounded, but as investors, we need to understand that because it's a 10-year play or a 7-year play or a 5-year play, typically a multifamily cycle is between 7 to 10 years. So that means the cycle is like this. It's like a wave. That means it goes up and down. So that means if you are holding a property for 10 years, the tendencies that you have, the low and the high period is very high. Except it's a short-term investment like 3 years, like the one Kwame did that they went in a high period and they went out in a very favorable period. So those things are rare. But on its standard typical deal, it's 10 years and you typically will go through ups and downs. So that is what exactly is happening. So if you only know how to navigate when things are good, then there will be problem. Because when the downtime comes, you'll be weirded out. I did a video about how my 2025 went. Fortunately, they had to trim it off to so long because I had a lot to talk about, but they had to trim it to a very short video. But one of the things I mentioned there was that so many people that were in this industry that I used to see every time, many of them are going back to their W2. It's not a coincidence. If you dig deep, some of them started when the market was favorable and they're not used to when the market is down. And somehow, they fell in the dish. Some of them have had to go through foreclosure and some of them had to go through just walking away from the property. It did not foreclose, but maybe they left the sponsor because they knew that it was going to nosedive anyway. They had to walk away. Some of them, they came with a wrong assumption that they were going to come and eat a large chunk of money or that they will be scooping money from the floor once you enter multifamily. I'm sure that's what some of you have heard. And multifamily is quick cash. You can get it now. So they came with that idea. Some of them resigned from their jobs and came in here and they were thinking it's a get rich quick scheme. Unfortunately for them, they learned that no, this is a long-term game and the seed is like a palm tree that grows. Palm tree, it takes time for palm trees to grow, but when it grows, it blows on. Once the seed starts to come out from the ground, it starts to as well as bamboo. I don't know how many of you know how many years bamboo stays on the ground before it comes out of the ground. It takes a lot of years, but when it grows, it's the tallest, it's as high as God knows what. That is how multifamily is. So if you're coming here assuming that you're going to come and scoop cash, this is not for you because you will fall along the wayside. And that is what has happened to majority of the so-called investors on this deal. Many of you have lost money. I can tell you for a fact. Many people have lost their money with some of these people. And so many are still going to lose in this year because some deals will still foreclose this year. And that I know. In December, I'm aware of 2 or 3 deals that foreclosed in that. I'm not saying that this to scare you, but I'm saying this for you to think twice, to know exactly what you're getting into. That's 1. 2, for you to understand it and navigate it properly. There's going to be challenges because the way it is being molded is up and down. That's the circle. That's how it works. You have the high time, you have the low time. God bless you. You have an opportunity like Kwame. I had the opportunity I bought 12 our deals during that time and I exited in early 2023 before they started increasing interest rate. So you can have that if it's a short one, but typically the longer those deals, the probability that it's going to build up value because the idea is you want to improve the properties, you want to improve the value, and it's not a one-day match. It takes time for you to make a property stable. It takes time for you to increase rent. Sometimes you might need to go through a full 1 year to start increasing rent. Some of you are in some of my deals. You can see that deals are different. Some deals are very fast, some deals are very slow. But the bottom line is, as long as you're following the fundamental, it's going to work out. That is the point. So we are going to discuss about those things that we literally went through some years ago. And I'm not excluding myself. We went through a lot and we were just like dodging bullets here and there. That's what we're doing, especially in this last year. You know, you wake up one morning, you see an email from a property manager because on all my deals, I'm the lead in the asset management. So I get access to information ahead of time, even before the team members. And sometimes I won't lie to you, I would not bring it to the team members because of some of them are new. They might not understand how these things work and they'll be scared. I remember one day our property manager felt that all my team members were like very experienced in the group because they've been with us. My property manager has been with us and she has noticed that all of them sound savvy. But she didn't know that these ones were kind of new. This was their first time because one of the things I try to do is to bring new people on board to learn, to grow. And that's the way life is supposed to be. You keep improving people's life and before you know it, you have a community of like-minded people and the stress just goes off you. That is what it's supposed to be. So during that meeting, the property manager was, oh, baby, and there was some gunshot and this, that. She was just talking normally property because sometimes it's normal. We're in Dallas. You don't have to be in the rough area for you to hear gunshots. Sometimes, if 10 friends are walking, at least 8 or 9 of them are carrying gun in Texas, right? Because you know that almost everybody have a gun. That means you are likely to hear one regardless of where the environment is. So she was talking and she said, oh, there was a gunshot and all that. And my next question was, oh, okay, what happened? I was just so neutral because I know what we bought. I know that where we bought the property does not have gangs for them to be shooting. But do you know that some of the team members were so scared? They kept sending message, oh, baby, so what's the update? What happened? They were so freaked out. Why I'm saying this is that because we're new, it takes time for us to go. And those news, sometimes I'm like the shock absorber. I take in those messages, try to mitigate them to a certain level, especially when I have new people, and pass it on to the group. At the long run, everyone is going to know about it, but sometimes I try to mitigate the idea of some people panicking. Some people panic, really, So if some of you are hearing what I'm hearing, I'm sure some of you will shut down. So that is what it is. I'm not saying this to scare you guys, but it's important that we understand exactly where we are and what we are doing. So in this last year, we had some things that were driving the market. This last period from 2023, 24, 25, we had some drivers and they were so significant. The market played a role, but the assumption played a bigger role. So there's something we call projections. When we are buying a property, almost 100% of it are projections. And what are projections? Projections are things that in the future you're just assuming based on history, trends, and likelihood reports, the news and all that, and your research and experience you're getting to form your projections. So now, since you know that multifamily is based on projections, that means things are likely to go wrong if not properly done. And that is one of the reasons why I do not invest in too many markets, because I know the kind of projections that will go into a market might not be the same as the projection that will go go into another market. So now, if I am underwriting a deal, there's something we call stress test that regardless, you can't have it all sweet. You have to look for the worst case scenario and also look for the best case scenario. If your deal only works if the interest rate is low, then that's no deal. And that's what so many people did during that period. Interest rate was a major factor. But did some people survive it? Yes, some people survived the climb, the market. Why was that? Because they didn't go based on the trend, they went based on the fundamental. The fundamental is that we know that interest rate is not going to remain in a place. It fluctuates according to the 10 years treasury. How that reacts, that is how interest rate is going. And the Fed will do the baseline of it, then the 10 years will now do the real one that we used to close. If you know that knowledge, that means you should assume that my worst case scenario and my best case scenario, you have to assume that. And if it doesn't work, you walk out. So what people did during that time was interest rate, they went for floating rate with the assumption that they are going to run this property for 2 years, improve it, and exit on the 3rd year. I have business plans that are like that, but I don't go with that. I don't go through that pattern. I don't go with something that is very risky, like going through floating rate and assuming that the market will be good by the time I'm ready to go. No one knows what will happen in 2 years. If they had told some of us what would have happened last year, is any of you going to believe? I'm sure not. If they had told you that maybe people are going to lose their job last year, would you believe? No. If they had told you that inflation was going to get to 9% or that unemployment rate for some group of people to 8.4%, would you have believed? No, but it happened, right? So these are the things the projections needs to cater for. Some people say, baby, I want to get you a deal. And I don't say no to it, but I know what goes into it, especially if you are new, except if you're experienced. Fine. And if you're experienced, there's no reason why you might want to give me your deal because you're experienced equally. So if you're not experienced or you're getting me the deal, I'm likely to see loopholes. In short, all the ones they brought to me, I've seen loopholes. And to some extent, I even stopped looking at people's deals because I started feeling bad that always saying no. And I'm thinking that in their mind, they're saying baby is intentionally trying to spoil my deal so that she says no to it. So that's the way I'm feeling. So I've stopped looking at deals in those ways because you might not understand what goes into that. This is purely projections, and anything that you project wrongly, you might not be able to correct it. So in those cases where people were taking those fixed rates, some people that could see the future were locking in their rates. That's what they were doing. So they were creating business plan that was a longer year, like 5 to 10 years with a fixed rate. That alone was able to help them mitigate the rate. Whereas some people went for a shorter term rate and they assumed that in 2 years, the market was going to be favorable and they will exit and get a lower rate. But please, let's be frank. I want us to listen to this. You are going under contract for an interest rate of 3%. And you're assuming that it's going to be what? 3.5 or 4? How? Is that the norm? That's never been the norm. It happened because of COVID. We look at the market to make those projections. What is happening around us? What is bringing up this bubble? Is this a bubble or is it sustainable? That is a question. But some people, okay, like for example, there is a big probability. You guys have all heard that the Fed is under pressure to reduce interest rate. Right now, the GAG, they subpoenaed him, right? They are trying to sue him. The thing about that is that if it goes that way, it means that there's going to be a puppet there that will follow what the president is saying and interest rate will go down. And for some of us that are buying this during the period where interest rates will go down, let's assume he succeeds and the interest rate goes down. Do you know that after this year, he has just 3 years to go? That means if the next person comes in and there's inflation, interest rates will go up. And let's assume that your business plan is 5 years or 4 years. And the time at which you're going to exit is when a new government is coming and they're going to raise interest rates, or there's inflation, massive inflation, and they have to raise it. What would you do? So you have to take cognizance of everything around you. Is it going to be good? Is it going to be bad? So what people were not modeling is how best it can be and how bad it can be. How bad can it be? Can you survive if this thing collapses to this level? So last year, I put out a post, if you guys can remember, that we're going to refinance a property and it was worth 20 million. For those of you that have been listening to me, I said it 1 or 2 weeks to our closing. Our appraiser was almost out. Every other thing was done just for us to close. Once the appraiser comes in and everybody will go, everything was going fine. Well, guess what? Within that 2 weeks window, our occupancy dropped. We had eyes following people to their property from school. They'll follow school students from their school to their home. So we started started seeing some, what they call it, fear in the community, and so people were leaving. So the property now started becoming, as in, it moved from 90 something percent to below 90 something percent. And if you know, most lenders will not fund you with a fixed rate if you are below 90%. But looking at that, if we had a variable rate or our term was due, do you know, would have been panicking? That would have been an issue. But we did not panic because we still have about 3 more years to go. But right now we have the window to exit at any point in time. So that is how the acquisition works. You need to create different exit strategy. If you only have one exit strategy and that one exit strategy leads to when the conditions are favorable, then if it's unfavorable, know that there's trouble. What happened to us was unfavorable. We never knew that we're going to have such thing that was going to happen in just a drastic period, and just within a short window we became unstable, and because of that, and the thing fed right into the seasonal period where how to lease properties is low. Festive period, holiday period is low. If we were with a variable rate and we had to exit, we would have been in trouble. So because of that, the way we go about our lending is a major factor, and that is what some people did not factor in during last year, and that was a significant issue that made many deals fail, because they did not go in with the right financing and because they did not assume or anticipate that things were going to happen. And if things happen, what are the different exit strategy that you need to go out from? They didn't have those kind of conversation. So one of the things we try to do is we try to give ourselves windows in our exits. If it doesn't work in this year, let's try and see how we can make it work in this year, because we have a window to exit. We don't start our exits at that exit time. Like if we want to exit in 5 years, we'll not start exiting in 5 years. No, our exits are started from the time we've seen the window. We always underwrite even based on prepayment. You know, in multifamily, you can't exit wrongly because the lender needs to make their interest, because these things are expensive. They give you a large chunk of money and you don't expect them to make interest on it. No. So there's a fixed period you need to stay on before your prepayment penalties can be waived. All of you should know that if you own a home, you should know that even in single family, there's a period you cannot exit. And if you exit, you pay the lender some amount of money. So if you have a single family and you don't know about this, go and check your loan agreement. Is there. Typically 1 to 3 years for single family. And for multifamily, it's the same thing, sometimes to 4 years. You have that depending on the loan amount. Now, the point is, people did not factor in exiting at prepayment period. What if I see a window between now and my target year? Will I say, no, I will not exit, I'll wait till my target year? No. So at the point of acquisition, you are modeling those things, checking. There's a 2% prepayment in year 3. If I pay it, I'm assuming I have this scenario, can I still go out? Is it going to be a significant amount I'm going to pay to the lender for breaking the loan? Those are things we factor in, because when opportunity comes, you might have a short window to exercise it. So you want to take advantage of the window. Another thing that we saw again was operating costs. Recently, we've seen a lot of natural disaster. Insurance cost has gone up. Taxes is so high. This year, for the first time, we had a deficit in our taxes for 2 properties out of all our properties. This has never happened. And the reason is because taxes jumped up. They really went up. But the good news is that, especially for one of them, we anticipated that it was likely to happen because we're monitoring our escrow account to see in relation to the bill that we got towards the end of the year. We anticipated it. But the other one, we didn't anticipate it. But thank goodness we had reserve. I will pull that from the reserve because the lender just called and said, pay $45,000 now. You guys saw the message. For some of you that are on the deal, you saw the message. Please make payment as soon as possible. They are not even going to give you written space. Imagine them sending you that email and sending you a message like 3 hours later. Phoebe, have you sent it? I'm like, you just sent me this email. Allow me breathe, So you might not have that time to do that. So taxes and insurance played a significant role. So that is why at the beginning, we always try to involve the tax litigator, a tax attorney that gives us an idea of what the trend is likely to be. Regardless of them giving us a trend, we always still put a wiggle room because anything can happen. Like if I get a tax report of, your tax is going to be $230, I might add an additional $30,000 or $20,000. I know I'm doing it. I'm doing it because regardless, if it goes lower, the money is still going to come to us. No loss, we're not going to lose. But if it goes higher, that means I've made provision for a large chunk of it for the difference. Some of them did not do that from the beginning with a tax attorney or with the city, because these are conversations that you should have with the city or the tax attorney. And if you don't have it, there will be issues. So these were some of the problems we saw playing out. There's a property I was just having a conversation with someone that's near week, and I got to find that they were not paying the insurance, they were not paying the lender because no money, they could not foot it, and it might foreclose because the lender has given them warning already, So those are things that people did not take note of. You need to have reserve, at least 50% of this insurance and taxes, you should have them as reserve, or having a reserve and having a conversation with the tax attorney can help you litigate this. But this did not happen. So many people did not even research that these things will happen. The other one that we saw was rent growth. Remember, 2021, 2022, we had rent growth of 10%, 15%, even 20%. We saw rents going up, especially during the peak of inflation. And people were projecting that it will keep going up. Imagine you're projecting in year 1, your rent is going to go up by 10%. Year 2, you're saying 12%. Year 3, 14%. And you did that in 2022. Right now, in most markets, we know that rent is either 0 or flat or max 2. Only a few cases is 3%. We know that. So if you're underwriting, regardless of if the market is saying right now it's 10%, it's 10%. If that opportunity comes, you take it. But what if it doesn't come? Because what happened during the pandemic was kind of new to some of us, apart from the meltdown that happened in 2007, 2008. Apart from that, this pandemic was new, but I was not willing to go with the bubble. Some of us were not willing to go with the bubble. What did we do? We went to pre-pandemic trend. The properties I bought in 2022, 2023, I wasn't looking at the trends for 2020, 2021 because they were so not accurate, because I knew that this was because of the pandemic. We were going through what happened in 2018, 2017. What was the market on the average? That was what we were doing. When we were doing our projections, I was between 2 and 3. Even if the market told me it was going to be like 5%, 10%, we didn't do that because we have to be conservative, because things can happen. Like I said, multifamily is based on projections. So why do you want to be so aggressive when you know that you don't control tomorrow? In short, there are many things that affect us outwardly or outside that we don't have control over. Since you know that you don't have control over it, then why do you want to just go to the extreme? So those things affected some of us last year and the previous year. Rent growth is flat in some cases, and rent growth is max 2% in some markets. So most of my underwriting, sometimes year 1, year 2 is flat, sometimes it's 2%. I'm not going more than that, even when I know there are potentials, right? I'm not doing that. If the opportunity comes, far well and good. We're happy. Lending is tighter. Last year as well, lenders started increasing their criteria. So let me give you an example of what happened during that time. If you are closing a deal with Fannie Mae or Freddie, most times when they are doing the underwriting and the pre-qualification period, it can take them like 60 days. And remember, in your LOI, you have a time period to close, right? And if the lender is taking that time, and guess what? Sometimes after that 60 days, they come back to you and say, oh, based on this, you do not qualify. It can happen. It happened to me last year. And I was like, but we closed a bigger deal than this a year before. How come I do not qualify now? And they said, oh, that they've increased their criteria. So we had to quickly pivot. But if we had not underwritten the deal with different samples or different scenarios of what interest rates might likely do, we might have lost our EMD, because there was no way I would have closed the deal if I underwrote the deal for, let's say, 5%. And in reality, because of what happened, I had to now close the deal with 7%. And by closing at 7%, the deal is already bad. There's just one way, just for you to walk out from the deal. So we saw that happening. Most people did not model their deals with a worst case scenario interest rate, because typically you don't lock in the rate until you're about to close. So those things affected some deals. We saw deals having issues with that. Lenders, I wouldn't blame them, because they had to start increasing their conditions, because they found out that so many inexperienced people were jumping into multifamily because they felt that it was an easy gain. And most lenders found out that they had to collect those properties. Lenders don't like to collect properties because it's not good for their books. It's like a loss, and sometimes they can sell it for a loss. So they really don't like it. So in order for that, they increase their criteria, because they believe that before you can be able to meet those very high criteria. You should be very experienced. You should have been in this game for a while for you to meet these conditions. And sometimes they just want to like do it in such a way that it will be very difficult for you to even get it. And you move on to another one. So these things happen. You have to picture that, what if I'm not able to close with Fannie Mae after waiting for 60 days? If I have a terrible seller. Some of you know what happened to us in one of our deals. We had a terrible seller that when the time that was given, we got to that time, he said any other day outside that closing dates that we're supposed to have, we're going to pay 2,000 per day. He said it. He told us a month before that time, and we thought he was joking. Well, I sat down, I thought of it. I was like, this guy has been very tough from the beginning. It's possible that we'll not be able to get away with it. Immediately, we quickly switched to another lender. Even it was an assumable loan, the bottom line is that we had an interest rate of 5%. But guess what we closed with? 6.89%, almost 7%. And do you know how that worked for us? We underwrote the deal at 7% because we knew that things are likely to change. So if we did not do that, it would have been that we would have lost more than 200,000 on EMD because we would have walked away. So these were things that happened. Lenders were increasing their that. Another thing is some of the risk was not the market itself. Some of the risks were the operators, the owners, the GPs.